Hey everyone, welcome back. Ever feel like trying to really understand the US tax system is like walking into a maze, blindfolded?
Well, we're diving deep into that maze today. We've got these two incredibly detailed reports on the effects of federal taxes, and we're going to break it all down.
Yeah, let's do it.
So get this, one report actually points out that 9 more taxpayers go for that standard deduction instead of itemizing.
Wow, 9 times, really?
9. It's kind of like when you're at the supermarket,
I
right?
know.
And you just want to get through checkout quickly, so you head for the express lane.
It's all about simplicity. Totally. But it makes you wonder, what are we missing by not always digging deeper? What are the hidden implications of that choice? And that's just the tip of the iceberg. We're going to explore all sorts of interesting stuff. We're talking income disparities, those kind of hidden tax benefits most people don't even realize exist, and of course, the never-ending debate about capital gains. And I'm so glad to have our expert here with us again. They always manage to explain the stuff in a way that even I can understand. And trust me, that's saying something.
Well, I do my best. I have to say, though, that analogy with the express lane,
Huh.
spot on. It really does capture how a lot of people approach taxes, just trying to get it over with as painlessly as possible. But what we don't always consider is why so many people choose the standard deduction. I mean, is it really just about convenience? Or could there be other things at play, like different income levels, access to information on all those potential deductions, or even just how ridiculously complicated the tax code can be? These are all really important things to think about.
You're so right. With taxes, there's always way more going on than it seems at first glance. And speaking of seeing the bigger picture, let's talk about how we even measure something as basic as income.
You would think that would be simple, wouldn't you? But it's actually way more complicated than you might expect. We hear all the time about income inequality, right? But the thing is, those numbers can be super misleading depending on how you're actually measuring income in the first place.
Okay, so break it down for us. What are the different ways to look at it?
Well, you could be talking about someone's income before taxes or after taxes. You could be factoring in government transfers, like those Social Security checks or Medicare benefits, or not. Each way of looking at it tells a different story, especially when you start comparing those at the bottom of the income ladder, say the bottom 50%, to those at the very top, the top 1%.
And those stories are probably pretty different, huh?
You bet. For example, take a look at Figure 1A in the report. It shows how when you measure using pre-tax/pre-transfer income, basically ignoring taxes and government programs, the gap between these two groups is huge, and it's been growing for decades.
Wow, so that's the picture we usually see, the one that gets everyone riled up.
Exactly. But then look at Figure 1D. This one takes taxes and those government transfers into account. Suddenly the gap, while still there, isn't quite as dramatic, especially for those at the very bottom. It really highlights how important those government programs are for making things a bit more equal.
So the way we measure income can drastically change our whole understanding of how fair or unfair things are.
Exactly. It's all about context.
That's really fascinating. It makes you wonder, what other factors play into this whole complex equation of income and wealth in the U.S.?
Well, we can't really talk about income without talking about his best friend, wealth, right?
Makes sense to me.
And that's where things get really interesting, because the U.S. tax system, through all sorts of different rules and incentives, actually plays a big part in shaping how wealth is spread around. It also influences what kind of assets different income groups end up owning.
Okay, now you're talking about a system that has layers upon layers. We've got individual income tax, corporate income tax, estate taxes, social security taxes, and don't even get me started on the alternative minimum tax.
Right, it's a lot. It's like a whole other language. And you're right to point out how multifaceted it all is.
Yeah.
Each part of the system has a specific purpose, sure, but they all interact in these crazy, complicated ways. Like, let's take the AMT, for example.
Oh boy, the AMT.
You mentioned it earlier. And, less than 0.1% of taxpayers will actually have to deal with it in 2024. Now, when you hear a statistic like that, you might just think, phew, that's a relief. Doesn't apply to me.
Totally.
But, and this is the important part, it raises the question, who are those taxpayers? What sets them apart? That they fall into this special category.
Right. It can't just be random. Right.
Exactly. And often, it's people with a good chunk of income from specific sources, things like capital gains or certain deductions, that push them into AMT territory. It might not even be that they're ultra-high earners overall, but something about their financial situation just triggers this other layer of complexity.
It's like a hidden trapdoor in the tax code.
You think you're safe, and then boom, you're hit with an AMT.
It definitely adds to the feeling that this system is deliberately confusing. And speaking of things that are kind of hidden, you mentioned hidden tax benefits earlier. What are some of those that might surprise people listening?
One of the most interesting areas is how the tax code handles different types of income. Specifically, there's this crucial difference between progressive and regressive taxes. Understanding that difference is key to understanding how the whole tax burden actually falls on different income groups.
Okay, yeah, those terms get tossed around a lot, but honestly, a little reminder never hurts. Remind us, what exactly is the difference between progressive and regressive?
So a progressive tax system basically takes a bigger percentage from those with higher incomes compared to those with lower incomes.
So the more you earn, the more you potentially pay.
Exactly. It's like a sliding scale where as your income goes up, the percentage you pay in taxes goes up too.
Okay, that makes sense.
The federal income tax is a classic example of this. We've got those different tax brackets based on how much you earn.
Right, right.
Now, on the flip side, a regressive tax system does the opposite. It takes a bigger percentage of income from lower income folks than from the higher earners.
Wait, so even though everyone is paying taxes, the percentage actually hits lower earners harder?
Yes. Now,
Yeah.
it doesn't automatically mean that the wealthy are paying less overall in terms of dollars and cents, but that percentage of their income going towards taxes is definitely smaller.
Oh, I see. So a regressive tax might look the same for everyone on the surface, but under the surface, it's actually impacting those with less to spare more significantly. And we see examples of this in the U.S. tax code, don't we?
We absolutely do. A really clear example is the sales tax. Let's say there's a 6% sales tax on something that costs $100. Whether you make $50,000 a year or $500,000 a year, you're still forking over the same $6 in sales tax.
Right.
But, and here's the kicker, that $6 represents a much bigger chunk of the lower income person's budget.
Guess you think.
It does. And in fact, Table 3 in the report actually lays it all out. It breaks down the impact of different types of taxes on various income levels. It's pretty eye-opening to see how these things play out in the real world. While we're on the topic of how taxes can actually shape how wealth is, like distributed,
Yeah.
we can't forget about how it impacts what people own.
You mean like what kind of assets people have?
Exactly. And Table 6 in this report, it really highlights the difference in what the top 1% owns versus everyone else. It's not even just about having more money. It's about what that money is invested in.
Okay, so we're going beyond just income levels now and looking at the bigger picture of like building wealth over time.
Exactly. Because while owning a home, that's still a big deal for a lot of Americans, right? But the top 1%, they hold a huge chunk of things like corporate stocks, private businesses, even stuff like art and collectibles.
Fancy.
Right. And those things, they tend to increase in value way faster than your average savings account or even real estate. It's like this cycle where the wealth gap just keeps growing.
It's like a snowball effect, right? The
Mhm.
more you have of a certain kind of asset, the more wealth it can generate. But then those assets are often out of reach for anyone who doesn't already have a bunch of wealth.
It's a bit of a chicken and egg situation. And of course, the tax code, it plays a role in this whole dynamic too.
I bet. Especially when it comes to how we tax those profits from selling assets, like stocks or real estate. What's the technical term for those profits again?
Capital gains.
Right, capital gains. So how do those work?
So right now, those gains are taxed only when you actually sell the asset. And here's the kicker. They're often taxed at a lower rate than your regular income.
So it's like what do they call it, a tax break for people who are already making money from their investments?
You could say that.
I knew it. But seriously, I've heard people arguing about this forever. This is that whole capital gains debate.
You got it. It's a big one. And there are definitely strong arguments on both sides.
Lay it on me. What do people who support the current system say?
Well, their main point is that it encourages investment, which makes sense on the surface, right?
Yeah.
Because if you know you'll be taxed less on those profits when you sell, you might be more likely to invest in the first place.
It's like a little nudge from the government, like, come on, invest, help the economy grow.
Exactly.
But what about the downsides? There have to be some, right?
Oh, there are.
Yeah.
The folks who aren't too keen on this system, they argue it really gives an advantage to those who are already well off. Those with higher incomes are way more likely to have extra money lying around to invest, right?
Right, makes sense.
And they can afford to hold on to those investments for way longer. That means they might even qualify for those even lower long-term capital gains rates.
So it's like the system might encourage investment overall, which sounds great, but those who are already doing well are in the best position to, like,
really benefit from it. Doesn't seem totally fair.
That's the big criticism, for sure. It definitely raises questions about fairness and, who's really benefiting from these tax breaks.
Definitely something to think about. What else? What other arguments are there?
Well, it gets even more complicated when you throw in this thing called the lock-in effect. Have you heard of that?
I think so. It sounds familiar. Remind me.
So because you only pay taxes on those capital gains when you actually sell the asset, some investors hold on to them for much longer than they normally would just to, delay paying those taxes.
Delaying the inevitable. I get it.
And it can actually mess things up in the market because that money might not be going to the places where it could be most useful or productive. It's kind of stuck.
It's like a game of financial freeze tag. Everyone's holding their breath, waiting to see who cracks first and sells.
Kinda. And then there's the whole other debate about taxing those gains before you sell, those unrealized gains.
Oh, yeah. That one always ruffles some feathers. Isn't that like taxing someone on the potential value of something, even if they haven't actually made any money from it yet?
That's the gist of it. Imagine having to pay taxes on, say, your stock portfolio increasing in value every year, even if you haven't sold a single share. That's essentially what mark-to-market taxation is all about.
That just sounds stressful.
I know, right? The idea behind it is to stop wealthy people from putting off paying taxes forever. But it comes with a whole bunch of new problems.
Like what?
Well, for one thing, how do you figure out the market value of everything every year, especially for things that aren't constantly being traded on the open market? That would be a logistical nightmare.
Right. Some things are easier to put a price tag on than others.
Exactly. And then what happens when someone's investments lose value one year? They see a big drop, but then they rebound the next. Can they get those losses back from a tax perspective?
Oh, man, my head's already spinning.
I know. There are just so many layers to consider. It's not as easy as just saying, let's tax unrealized gains. You need all these other mechanisms in place to deal with the ups and downs, the potential losses, and make sure it doesn't completely discourage people from investing in the first place.
Talk about a balancing act. So are there any other proposals out there?
Well, one idea that gets tossed around is using deferral charges.
Deferral charges. Okay, I'm intrigued. What's that?
The basic idea is this. If you're going to let people put off paying taxes on those unrealized gains, why not charge them a fee for that privilege? That fee could help offset the advantage they're getting by not paying right away.
That makes a certain amount of sense. But I'm guessing it can't be that easy.
Of course not. Figuring out a fair interest rate for those deferral charges, accounting for investment losses, making sure the whole system doesn't scare away investors. Not so simple.
Right. It's like trying to juggle chainsaws while riding a unicycle on a tightrope.
Pretty much. And that, my friend, is what makes this whole topic both frustrating and totally fascinating. No easy answers, just a constant search for that sweet spot.
A never-ending quest for tax equilibrium. And speaking of balancing acts, let's switch gears a bit and tackle another one of those tax terms that always gets people talking: carried interest.
Ah, yes, carried interest. This is where it gets really interesting, because this is a prime example of how certain parts of the tax code can have a huge impact on specific industries and, of course, different income levels.
For those of us who aren't, tax code experts, can you give us a little refresher on what carried interest even is?
You got it. In the simplest terms, it lets certain people, usually partners in things like investment funds or private equity firms, receive part of their profits as capital gains instead of their regular income.
Okay, and why is that such a big deal?
Remember how we were just talking about how capital gains are often taxed at a lower rate than your regular income?
Oh, right, yeah. So it's like they're getting a special lower tax rate on money they made from their work just because of how they structured the whole thing. Sneaky.
That's basically the argument, yeah. People who criticize this system, they say it's totally unfair. They say it lets these high earners pay a smaller percentage of their income in taxes compared to someone working a regular job and getting a paycheck. Income is income, right?
It does make you wonder who wrote these rules in the first place. But I imagine there's got to be another side to this story too, right?
There always is. And the folks who defend carried interest, they say it's actually super important for encouraging risk-taking and entrepreneurship. They argue that those managing these big investment funds are taking huge gambles with their money, and that carried interest rewards their successes, which then encourages them to invest in potentially risky but also potentially very profitable ventures that could help the whole economy.
Okay, I see. So it's all about incentivizing people to make bold moves, create jobs, boost the economy. It's like the higher the risk, the higher the potential reward, and the tax system should reflect that.
Exactly. And they often bring up this concept of sweat equity, the idea that these folks are creating value through their work, just like an entrepreneur busting their tail to build a company from the ground up. They say that taxing carried interest, like regular income would, like stifle innovation and make people think twice before investing in anything even slightly risky.
Okay, that makes sense. It's like punishing people for taking a chance on something new. But then again, should some types of work be rewarded differently in the tax code? It's a tough one.
It definitely is.
Oh.
And that's what makes it such a fascinating debate. It's about more than just the nitty-gritty of taxes. It's about what kind of economic system we want to have, who benefits, and how we value different kinds of work and risk.
Such a good point. It's like, are we all about rewarding those big wins, even if it means some people get a bigger piece of the pie? It's really about values and priorities as a society.
Exactly. Tax policy, it's never just about the numbers,
Mhm.
It's about our values and the kind of world we want to live in.
Deep, man. And speaking of planning for the future, let's dive into another big part of the tax code: estate planning. Get ready, folks, because we're going deep into the world of grantor trusts.
Grantor trusts. These things are like the VIP section of the tax world. They're these legal tools that let people transfer stuff they own, their assets, usually to their heirs, but in a way that can potentially really lower those estate taxes.
Okay, so it's like a way to make sure your money goes where you want it to after you're gone, all while dodging those hefty estate tax bills. That sounds like something those folks benefiting from the capital gains structure we talked about would be all over.
You're catching on. You see, with a grantor trust, the person who creates it, the grantor, they're still considered the owner for tax purposes, even though the assets are meant for someone else.
Wait, so they get to control the money and decide where it goes, but they're also still on the hook for paying taxes on it. What's the point of that?
The advantage is that by paying those taxes while they're alive, the grantor is basically removing those assets from their taxable estate. So when they pass away, that money in the trust can potentially go to their heirs without being hit with those potentially huge estate taxes.
I see. So it's like a strategic move to shrink the amount of your stuff that gets taxed when you pass it down.
Exactly. Clever, right?
Super clever. But like everything in the tax world, I'm guessing it's not quite as simple as it sounds.
You know me too well. As with anything, there are always nuances, potential drawbacks. You know the drill.
Hit me with them. What do we need to watch out for?
So while these grantor trusts can be super helpful for estate planning, some people argue they can be used for some not-so-kosher tax avoidance schemes.
Oh, no. Give me the dirt. What are we talking about here?
One example that always comes up is the intentionally defective grantor trust, the IDGT.
The IDGT, intentionally defective. That sounds kind of shady. What makes it so defective?
Basically, the person setting up the trust, they intentionally give up some control over it on paper, which technically makes it a separate entity for tax purposes. But they keep enough control to still be considered the owner for income tax purposes.
Wait, so it's a trust that's designed to be not really a trust.
In a way. It seems counterintuitive, but it lets them shift those assets out of their estate for estate tax purposes, but still get the benefits of paying income taxes on them personally, often at a lower rate than the trust would pay as its own separate thing.
So it's like having your cake and eating it too.
Pretty much. And you can imagine this whole thing sparks a lot of debate.
I bet. Who's for it and who's against it?
Well, the folks who like it, they argue it's a totally legit way to protect your assets, make sure your loved ones are taken care of, and of course, lower those tax burdens, the ones who aren't so thrilled. They say it mainly benefits the wealthy who can afford fancy lawyers and accountants to set up these complicated schemes. They say it just makes the whole wealth gap even worse.
So is it a helpful tool or a sneaky loophole?
That's the million-dollar question, isn't it? It all depends on your perspective.
This is why I need a professional to handle this stuff. My brain hurts.
I don't blame you. These are tricky waters to navigate. It's important to understand what you're getting into and make sure you're not accidentally crossing any lines.
Agreed. So, speaking of navigating complicated financial stuff, what about that other thing, the one that's popular with the super wealthy, private placement life insurance, right? PPLI.
Ugh, PPLI. Now there's a whole other world for you. It's often misunderstood and seen as this super secret financial tool. It's basically a type of life insurance that comes with a death benefit, like regular life insurance, but it also has this investment component that's got some pretty sweet tax advantages.
Okay, so it's not just about making sure your family's taken care of if something happens to you. It's also about using the policy as a way to grow your money without the tax man taking a big bite.
You got it. One of the big perks of PPLI is that the cash value inside the policy grows tax deferred. You only pay taxes on those gains when you actually take the money out.
It's like a little vacation home for your money where the IRS isn't allowed to visit, at least for a while. But there have to be some downsides, right?
There always are. PPLI isn't for everyone. It's complicated and usually only available to people who already have a good chunk of change. Plus, there are some policy concerns to keep in mind.
Oh, like what? Are we talking ethical dilemmas here?
Kind of. One concern is that some folks might use PPLI just to avoid paying taxes, sheltering tons of money indefinitely, and that raises questions about whether it's really fair and if it undermines the whole point of having a tax system in the first place.
Yeah, it's one thing to use legal strategies to reduce your tax burden, but it's another thing to completely game the system.
Right. And then there's also the worry that the tax benefits might overshadow the whole life insurance aspect of it, which could lead to some weird stuff happening in the market.
So it's like walking this fine line between legitimate financial planning and like abusing loopholes to avoid paying your fair share.
It's a constant balancing act, that's for sure.
Speaking of balancing acts, we can't forget about the net investment income tax, right? The NIIT.
Oh yeah, the NIIT. This one's especially important for those who earned a good chunk of their income from investments.
Right, right. It's all coming back to me now. What was it again?
So it's a relatively new tax, just came about in 2013 as part of the Affordable Care Act. Basically, it's a 3.8% tax on certain types of investment income, but only for people whose income is above a certain level.
So it's like an extra tax on top of the regular income taxes you're already paying on those investments. I can't imagine that went over well when it was first introduced.
You could say that again. But the idea behind it was to use that money to help pay for healthcare reform. And the thought was to target those higher earners who were making most of their money from investments.
Okay, that makes sense. But knowing this tax system, it can't be that straightforward, can it? There've got to be some quirks to it, right?
You know it. One tricky thing about the NIT is how it works with other taxes, especially for people who own what are called pass-through entities, things like partnerships or S corporations.
Pass-through entities, that sounds complicated.
They can be, but the source material we're looking at actually points out that there are certain situations where the income from these pass-through businesses might not be subject to any kind of 3.8% tax rate at all, including the NIT.
Hold on, so you're telling me there are loopholes where investment income can totally escape that 3.8% tax, even though it seems like it should apply? How does that even work?
It's all about how the business is set up and how the income is classified. Let me give you an example. Say you're an owner-employee of an S corporation, right? You might only pay Medicare taxes on what's considered your reasonable compensation, which is basically your salary as an employee. But the profits you get from the S corp, those might not be subject to the additional Medicare tax or the NIIT, depending on the specifics of how it's categorized and paid out.
Okay, my brain is officially fried. You lost me somewhere around pass-through entities. But the takeaway here is that the NII is just another layer of complexity in this already ridiculously complicated tax system.
You got it. It's like trying to solve a puzzle where the pieces keep changing shape. And it just goes to show understanding these tiny details can make a huge difference when it comes to how much you owe in taxes.
It's like they always say, the devil is in the details.
Exactly. And it's not just about the super rich either. Tax planning is important for everyone, no matter your income level.
Totally. Everyone wants to save money on taxes. It's just that most of us don't have the time or brainpower to become tax code experts. It's true, trying to wrap your head around all this tax stuff can feel like a full-time job. But we've covered a lot of ground today, from those income disparities and how we measure them, to all those hidden tax benefits and loopholes, the ins and outs of capital gains, and even those grantor trusts and PPLI, which still sound a little bit like science fiction to me, to be honest.
It's a lot to digest.
It really is. So as we start to wrap up this deep dive, what's really sticking with you? What's the most surprising or thought-provoking thing we've talked about today? What's going to keep you up at night?
Ooh, that's a tough one. You're right, there's a lot to unpack here. But I think what stands out most to me is just how connected it all really is. We tend to think about taxes as, the price we pay for roads and schools and all those government services.
Right, that's the basic idea, right.
Exactly. But it's so much bigger than that. The tax code, it's really a powerful tool. It shapes how our economy works, how wealth is distributed, even what we value as a society.
It's like a reflection of our priorities as a nation.
Yes, exactly.
And when we look at it that way, we see both the good and the bad, right? We see rules meant to encourage investment and new ideas, but then we also see how those same rules can accidentally make inequality worse. It's this constant push and pull trying to find the right balance.
Absolutely. And that's why it's so important for everyone to be a part of this conversation. It
Yeah.
doesn't matter how much money you make or what your political views are, because the choices we make about tax policy, they have huge consequences for everyone. We're talking about healthcare, education, even our social safety net. It all comes back to taxes in one way or another.
It's not just numbers on a page, it's about real people's lives. And it's about making sure those systems we create are actually fair to everyone, that they actually help people, not just a select few.
Couldn't have said it better myself.
So as you go about your day, remember what we've talked about today. You've got a better understanding now of how this whole tax system works, the good, the bad, and the just plain confusing. And remember, your voice matters. Talk to people about this stuff, ask the tough questions, and support policies that actually reflect what you believe in.
It's about making informed choices.
Exactly, because we're all in this together, right? Trying to navigate this crazy maze of a tax code and hopefully come out on the other side with a system that works for everyone. And on that note, we've come to the end of our deep dive. We hope you've enjoyed this little exploration of the U.S. tax system. It's complicated, it's messy, and it impacts every single one of us. So until next time, stay curious, stay informed, and remember, knowledge is power, especially when it comes to something as important as your taxes.